When you think about acquisitions, how many of them went the way of the model? How many that we modeled out have gone exactly as modeled?
There's just a lot of unknowns when you buy small businesses.
They believe in AI so much that they don't want AI to kill the business.
And so I feel like there's more activity, that we just kind of talked about over the past maybe 12 months. And it was a little bit slower for maybe 23, 24, and 25.
We had one guy whose wife said, "This is the year you're selling your business." And so
no more summers.
He said, "Yes, ma'am."
But I think also what I've seen more is price per door.
You give me the price and I'll give you the terms. If you're a seller, you have a lot of invested in that brand.
I've seen very few companies that just on a referral basis generate leads. I think that would tell you that you've got a really good brand. Do they have lead-based paint? Do they have all the disclosures? Do they have all the documentation?
What do you do with my employees? All right, everybody, welcome back to another episode of the Evernest Property Management Show. I am your host, Matthew Whitaker, and I'm back with my co-host, Gray Hall. Gray, what's going on?
Glad to be back. Talking something we haven't talked about in 6 months.
Yeah, well, this is all our biggest listened to episodes have to do with acquisitions. We're coming out of summer right now. There's a lot of people that are saying, I do not want to spend another summer, doing these turns, leasing these houses, dealing with vendors.
We've never had that thought this summer,
Actually, I may be having that thought right now, but at least our team definitely is. But, this is the time where a lot of people come out of summer and they think, hey, I am ready to start. I'm kind of like tired. I'm ready to start thinking about selling this business. And so we thought we would do a one-off episode that just talks to people about selling their business, state of the market, some lessons learned from buying 33 property management companies.
Yeah. These are always fun to talk about. And I think why they're the most listened to is, I think the cool thing is for a long time, people didn't know that they had a sellable asset. And like the more people that realize that as they kind of get ready to transition, it is a huge question because it's a huge life change. Like this has been a huge part of your life. And anybody who's built this business and been up for 10 or 15 years, like it's a big process to kind of go through. And so hopefully we can share some information that points you in the right direction of what life might look like after and things to consider.
Yeah, we're getting a lot of questions right now. We've got, I was on today with a guy. I had 30 minutes scheduled. We went way over. I said, hey, I got another meeting I got to jump into. We scheduled another 30 minutes this afternoon. We spent over an hour together just answering questions. So, excited to get into some of this with you. I think the first question for you, Gray, is, when you think about acquisitions, how many of them went the way of the model? How many that we modeled out have gone exactly as modeled?
What's that quote? I probably should have looked up the quote about like planning. Like none of them is the short answer but I think there's a lot of benefit in planning, but none of them have gone according to plan. There's just a lot of unknowns when you buy small businesses, and you can diligence everything and you think that you've got a plan. And then you get in there and you figure out a piece of information that is material, or the broker quits, or so there's kind of any number of things. And so we put a lot of focus on trying to do due diligence and have all our everything kind of checked out. But the reality is like none of these go according to plan.
Yep. And we're going to get into, obviously, let me just hit the items that we're going to talk about. We're going to get into how companies are getting valued in 2026. Talk about some multiples that we've seen in deals in the property management space. 3 things in diligence that predict whether a deal works. I was looking ahead at this and laughing. And then the last thing is why integration is not the last phase of an acquisition. It is actually the product you're buying. So by the end, we're going to promise you that you're going to know what to underwrite if you're a buyer, and the seller is going to know what to expect as some buyers start picking them apart.
Yeah.
And that was this guy's questions. He was like, what do I need to do for this? What do I need to do for that? So I
love an engaged seller like that. Like when people are engaged like that and have conversations early on, those are like fun things to do to give people advice about how they make their business worth more.
For sure, for sure. So let's kick off with the state of the market. You know very well how property management companies are, and the thing I would say too is that everybody will say in social media, hey, property management is hot, private equity folks are reaching out to me, but that's just not happening in the SFR manager space. That's happening across all of property management right now.
Yeah, and I'd say service businesses in general is an industry that private equity has really been in the past couple of years. But when you think about HOA, short-term rentals, there's a lot of private equity interest in short-term rentals right now. Multifamily, single family, like there are groups that are either kind of investing in and they either own assets in, and then they want the service side as well. And so there's a lot of, industry kind of appetite to buy either regional businesses or kind of like roll up on a national platform.
There's a multifamily company out of Texas that just recently traded for over $1 billion. I think they recapped it.
Third-party manager?
Third-party multifamily manager. There's been a number of HOA transactions that have taken place in the space in the last 12 months. It's just a really hot space. And so a lot of SFR has a lot of the same characteristics as these other ones. It also has some really different characteristics, which, interestingly enough, private equity has held off on investing a lot in SFR like they have in HOA and multifamily management and short-term management because of this. But, and we should talk about some of those things. Like, what do you see as the difference between those other property managers and the space that we sit in?
The other property managers, like the other verticals.
Yeah, the HOA verticals.
I know short-term rental it is still very fragmented. So like our industry is extremely fragmented. That business has not been figured out on a national scale. Like Vacasa had the run a couple of years ago, but you're starting to see a lot more consolidation. Like I know of 6 or 7 different platform groups that are looking to buy their first platform and kind of roll it up. And there's some bigger ones in that space.
Can I say something about that? What's interesting about, like, a lot of people think that SFR is consolidating, but it's still super fractured. So I wouldn't think, if you've been in this space a while, it has consolidated relative to where you got into it, but it is not consolidated. From somebody from the outside looking in, it's not consolidated at all.
No, because if you look at multifamily, like Greystar now manages over, how many units is it?
Yeah, it's like 800,000.
Yeah. It's almost like 1 million. I think they pushed
was like
over
a year ago, but they
pushed over 1 million units, but there's been institutional capital in that space for 30, 40, 50 years. So SFR really didn't have institutional capital until 2009, 2010. So it's kind of like 15 or 16. So that's probably what stands out to me. It's like still one of the earliest of all of those kind of real estate verticals. And it's just a logistics game and kind of like multiple markets. And so I think we're still early on. And so because it's, it's still more fragmented than multifamily, like that tells me that there is a path, because those 1 million units are not all huge complexes. It's a conglomerate of really small communities, maybe 300 or 400 here, which is different than single family. I think we will get there. It's just still early.
And I think it's interesting that you said short-term is kind of in the same spot as SFR, because I think of both of them as super operationally heavy. As a short-term rental manager, while the revenue per door is outrageous, like compared to SFR, but you have a new resident moving in every week. Right? So it's super operationally intense, and it's similar to SFR. Like, it is hard for us to manage multiple houses across multiple neighborhoods, maybe across the whole city, across multiple states with different owners. It's just really, really different. And so those two profiles are very similar.
Yeah. And multifamily is still operationally heavy, but when it's concentrated in one location, like that is different. And then you've got the HOA management, which is different. You got a lot of homeowners and there's like challenges that come with that. But when it's like a community association, like less operationally intensive, kind of like less knife fight of just kind of in between vendors and residents and owners. And so that's probably one of the reasons that they have scale and there was money there earlier. I think that will happen just as technology gets better and as there are more groups chasing, the short-term world and then the STR world. I think that will happen, but I think it is operationally harder to operate these businesses at scale than some of the other industries that have been rolled up.
The second thing I would say too is SFR by its nature, all the other ones are always going to have a manager. A big multifamily building is always going to have a manager, and HOA generally is always going to have a manager. The thing about SFR, even short-term rental, is generally always going to have a manager. I mean, somebody can self-manage. But the difference with SFR is I may be super happy with my manager, but I might want to sell it and realize my home price appreciation. And so if a person who's been renting it for 4 or 5 years sells it and wants to make that money back, they can do that. And they may still think that Evernest was great, but they're still going to sell it, and it's still going to be a churn door.
Yeah. And you can't really self-manage the 300 unit multifamily, but you can do it with one single family. It's gotten easier to do it kind of out of state. And so there's some like different pressures, but I think that's also the opportunity is like the TAM on all of these are huge. And especially like the TAM on single family rentals is greater than the multifamily kind of total addressable market. And so I think those are like a lot of reasons like why money's coming in the space. How would you compare that to 21 to 22, 23 to 25, like where today do you kind of see the market for buying these businesses?
Yeah, I think that 21 and 22 were the hottest this has ever been. And I don't think it's like necessarily hot. It was not necessarily hot relative to those other spaces. So while it was the peak for SFR, it was not the peak for all of property management. I think that prices got to a point where some of the deals that got pulled forward, people maybe were thinking, hey, I better sell now. I don't know how much longer this is going to last. And I think 23, 24, and 25 have kind of been a little bit of the desert, so to speak, where there's just not a lot of transactions taking place. But I have heard of, I actually haven't spoken with, but I've heard of 2 or 3 groups that are starting to look for platforms out there and starting to get into the space. And I think the other thing, which relates to the conversation we were just having, I think that people understand that a churn at or about 20% is normal for the industry. And so there are private equity people that are willing to invest money in the space that come with the mindset of, hey, that's just the nature of the industry, and we're gonna have to figure out a way to outrun that, hole in the bottom of the business, so to speak. So what I think is that equity is starting to accept the fact that that's part of the business and think of ways they can continue to grow from that.
And I think prices maybe expectations have come down, because when I was having conversations in like 24, people had offers for 2x. Now, not all of them closed, but there's one business owner I talked to and had a deal at 2x, and that fell through. And then, we talked a year and a half later, and I was having the conversation that kind of multiples have come down. But I think people have gotten used to the debt levels if you're using leverage on these. And I think with any market, like the price is going to come down where it makes sense to buy it with a reasonable amount of leverage. So I feel like that has kind of worked out. And I have talked to more like the searchers. So they may raise capital, they may do a self-funded search, but they are going out and they like the predictable cash flow of this. They like that it's operationally difficult, that you can get in there and operate. So I've started to see more, solo searchers or kind of small private equity groups targeting a roll-up strategy in the PM space. And so there's a little bit more competition on like people that we're talking to, nowhere close to what it was in 21, but I feel like it's a healthier market where the people that reach out have reasonable expectations of where the market is, what they can sell for. We're not kind of constantly having that discussion of, hey, we're here and we can't get there.
I'll tell you one other profile of equity groups that are looking to get into the space is they want to go find an analog business. And it's similar to the conversation that we've had a few times on this podcast. They want to go find a business that AI can't disrupt fully, but that you can apply some AI to and get some gross margin expansion from. So they believe in AI so much that they don't want AI to kill the business. And the great thing about us is, or the great thing about the space is, you still have people putting signs in yards and lock boxes on doors. Now, somebody may say, well, Tesla is trying to solve that with robots right now. And my guess is at some point we do have robots putting signs in yards. But also my guess is that's not going to happen in the next 5 to 7 years. And so there's just going to be a long runway before we get there. So the technology is moving into this space too, where people really feel like they can get gross margin expansion from implementing things like AI.
Yeah. I talked to a group that was their exact thesis, and they were under contract to buy a decent sized business, and they were going to use that as kind of their incubator to kind of build out their technology and prove out the thesis. And so I feel like there's more activity, that we just kind of talked about over the past maybe 12 months. And it was a little bit slower for maybe 23, 24, and 25.
The conversations you're having today with, or that we're having today with people that are interested in selling, like what are the reasons that they're wanting to sell?
The most common is they've been doing this. They kind of ended up in property management 15 to 20 years ago. The kids don't want to take over the business, or they're ready to be done. So like closer to retirement age, or their kids, have moved out of the house and they're kind of empty nesters and they want to do something like that's the most common is you see people who kind of got into it around 08, 09, 2010. They had a great 15, 16, 17 year run, and they're looking to, step back, not be in the day to day.
I totally agree. The only other thing I would say is I have talked to a lot of people that also want to stay in the industry and do something else, just not manage properties, whether that's work for a vendor, whether that's do some consulting. When you have 20 or 25 years of experience in this business, you can bring a lot of things to newbie property managers.
Yeah, and there's a lot of managers that they'll do brokerage as well as property management, and some of them want to continue to do the brokerage and sell a couple homes a year and kind of supplement their income that way. So not everybody's looking to like fully step back, but those are generally the most kind of common. And I think those are the people who are planning this. Like there are other people that we have bought from, and it's more so out of kind of crisis. And so you kind of get those when they happen and when they reach out.
And the obvious one is retirement.
Yeah. Yeah.
We still talk to people that are considering retirement. And what's interesting about those conversations is they start 2 or 3 years out.
Yeah.
And there's kind of like an ongoing conversation. And then what we've experienced is at some point something happens. Hopefully it's not a health event, but it could be a health event. We had one guy whose wife said, "This is the year you're selling your business." And so
no more summers.
he said, "Yes, ma'am," and sold the business. So you just never know, but there's some proverbial straw that breaks the camel's back that leads people to sell.
All right. Valuations. That's the number one question. That's why people are here.
I think you mentioned it a little bit earlier, but I do think valuations have come back. I think Peter Lohman actually posted a number of deals that, like a study of the number of deals, and a lot of the evidence says that stuff never really got up to 2 times. Although we do know of some actual deals that closed at 2 times, but nobody that submitted information to that paid 2 times. When we think about it as more of a revenue multiple, I know some people think of it as an EBITDA multiple. What I think is that the market is somewhere between 1 and 1.25 times revenue right now. Now, that also comes with some structure. It's not a cash offer, but what we've seen is that some portion of it is cash, some portion of it is either a note or an earnout or something related to that. And what that looks like varies very widely of the deals that we've seen.
And even on revenue multiples. So, and real quick, I think there's 2 general ways that you value these. It's either a multiple of like EBITDA or seller discretionary earnings or net profit or revenue. And with these smaller businesses, sellers can run expenses through the business, or they may pay themselves a salary. They may live off distribution. So it's really hard to kind of like clearly understand what these are in these like sub $1 million businesses. I think as you get bigger, you kind of have to have some structure in there. But a management fee is a management fee and a leasing fee is a leasing fee. And there's kind of like there's no arguing about it. And so you kind of know what you're buying. And that's why we generally look at these on more of a revenue multiple. But I think also what I've seen more is price per door kind of come up, because, one business may have really low flat fees, but a ton of maintenance, and that might be $1 million. But there's another business with really high management fees and leasing fees and no maintenance. Like those are two structurally different businesses, and so that's why you can't give just one answer. And the revenue number doesn't always tell you.
Let me ask you, because you actually hit on two questions that I had. Price. Let's start with price per door. Price per door is coming up. Do you think that is because rents are higher and management fees are higher, and so we're willing to pay more higher price per door than we did historically?
I don't know. That's a good question. I think that when that starts to get referenced, it's on deals that have a higher property management revenue than maintenance. And generally all property management revenue. And you can talk about the same thing. I mean, if it's $2,500 per door, and then you could pay a 1x multiple. So it's another way of saying the same thing, but I generally see it on businesses that have higher average rents. That's primarily property management revenue. And it's a good way to kind of normalize. I think if you're looking at, different markets, like it's a good kind of benchmark if you're competing against another offer, kind of comparing different markets.
Because we found there's really kind of like there's all different slices of this, but at the hyperbolic ends, there's kind of two businesses. There's one, and this was similar to the guy I was talking to today, where the rents are low, Section 8, the units per owner is higher because you have a lot of investors. You have higher churn, but you make a lot of money off maintenance, and you make a lot of money off turns, and you make a lot of money off renovations when new clients come on. On the other end is a more stable market where the units per owner is like somewhere around 1, meaning everybody just owns one house, and they have higher rents. And our cutoff we've seen somewhere around $1,400. If it's below, it seems more like an investor market. If it's above, obviously the further you get away from 14, either way, it becomes even more extreme of that. But then you make a lot of money off the property management fees. There's not a lot of maintenance. The turns are much cheaper. The renovation on the way in, the punch list to get the new house onto the market is much less. So there's really two profiles. And what I was explaining, and this is kind of like the question I have for you, which was number 2, is, we're willing to pay more for property management fees because the gross margin on property management fees is higher.
Yep.
Why don't you explain the difference between gross margin and property management, or how we see it, and maintenance, and then why we pay a lower multiple on maintenance, if at all?
Yeah. And so, $1 of property management revenue and maintenance revenue does not drop to the bottom line. And so what we generally see for property management, so this would be your leasing fees, your management fees, renewal fees, late fees, all of that kind of traditional property management income. The costs of the people and everything else to service that is generally about 50% of the revenue. And so if you have $1,000 in revenue, it generally costs about $500 in personnel. And so 500 would drop to the bottom line as gross profit. Where maintenance, your costs are just a lot higher. You got to pay maintenance techs to go out there. You got to pay turn vendors. And so that gross margin is somewhere between 20 and 30%. And so when we look at a business that has property management revenue and maintenance revenue, one thing I've done is split them up. And hey, this is the revenue multiple on the PM revenue, and here's a multiple that is lower on the maintenance just because it generates less profit. Because the only reason, again, we use the revenue multiple is it's indicative of what the kind of EBITDA multiple is. And so you've got to kind of adjust the multiples there, because really we're trying to buy the gross profit, and you can't make 60, 70% on maintenance. It's just not possible with market rates. And so you have to kind of split up the revenues and look at them differently.
Yeah. And so if you paid one-time revenue on both of those, it would take you 3 years to recover the maintenance revenue. It would take you 2 years to cover the management revenue. And let me add one more thing to that. The thing I told him is that the maintenance gross margin does not, you don't get a lot of expansion as you get density. I mean, you do get some. Maybe you move from 25 to 30% or 25 to 27%, but it's really hard at scale. You're still kind of getting that same those same dollars dropping to the bottom line. What we have found that is different is with property management fees, when we get density in a market, that 50% is probably the bottom, right? Like it can go to 55, 60, 65%. So each incremental door is coming on maybe at more like a 70% or 75% gross margin, and that's bleeding the whole thing to make it the average go up. Meaning that revenue is better revenue to me because I can get the benefits of scale. And there's really two things that I think are starting to give the benefits of scale. It's obviously density. We know about we've been doing a ton of analysis from our 200 door market to our 600 door market, which we think 600 is kind of like a scaled market. We make 1.5 times the gross margin dollars. Meaning we make 50% more dollars on
the same
per
house.
Per house. And so when you go from a small market to a big market, we're going to pay more because we want to get all the doors across that big market phase, right?
Yeah.
And so it just, that's the reason people don't understand why we won't pay the same thing for the same revenue, but not all revenue is created equal is probably the best way to say it.
And this is part of the reason we do these is there may be times that we have property managers that are not at full capacity and you actually don't have to hire anybody and you can take on a smaller portfolio and then it's not 50% gross margin. That might be 80 or 90% gross margin. And so there's a lot of cases if you kind of have slack in your system that you can take on these smaller acquisitions. And that's when you start to kind of get those, 1.5x in the gross profit.
Today's episode is sponsored by Crane. Look, if you've been in this business for any amount of time, you know how isolating it can be. When it comes to scaling past 200, 500, or 1,000 doors, the stuff that keeps you up at night doesn't always have clear answers readily available. You just have to know other operators who have been through it, and making those connections can be tough, especially if you don't know where to start. That's really what Crane is. It's a private, exclusive community for property management owners founded by Peter Lohman and Wolfgang Kroski. It's a place where you can ask almost anything and get thoughtful answers from other people in your same position. You can also browse other people's insights and get answers to questions you didn't even know you had on their website. They do monthly workshops, real-world dinners, and meetups across the country. Applications only open twice per year and spots go fast when they do. So head over to joincrane.co. That's joincrane.co to get on the wait list. If you're serious about running a real PM company, this is the place to be. Talk about, there's a lot of people that get a lot of brokerage leads out of their business. We've had a few conversations recently with people like that. How do we think about that revenue?
The pickle that you can be in is you can make a lot of money from that, but it's not recurring. It's hard for us to buy and value that because a lot of that is relationship based. Very little of it that I have seen naturally comes through channels that are purely there for property management. So it's not just naturally you have property management focused revenue and then you get all of this brokerage revenue. You've got a market for that. And then oftentimes it's also retail home buyers. And so you might be working as a buyer's agent or a listing agent. And so I think they can be great businesses that have a lot of synergies. It's just not what we do. And it's really hard for that to always kind of transition because we're buying the future cash flows. And I just don't have a high level of conviction that if we pay a multiple on brokerage revenue, that in 5 years, that revenue will have grown or even still be there. And so the pickle that you can be in is you've got this business and it's got synergies and you can feed the brokerage side of the business and the brokerage side feeds the property management side of the business. And you make a lot of kind of profit off of that. But there are some buyers who just cannot pay,
it's hard
can't pay for it.
It's hard for us to get the value out of that brokerage business.
Yeah, we can't get the value.
A lot of that brokerage business is just simply relationships which don't transfer to the new buyer.
Yeah. So that's tough because if you sell the PM business, maybe half of your leads go away. And so you find people kind of in that scenario.
Well, inherently too, if somebody doesn't know the new buyer,
Yeah.
it's going to take some time for them to warm up and know, oh, I can still sell through them. And maybe if trust is not built, I may feel more comfortable going with another agent right off the bat.
Yeah.
So one thing I want to say too is when we think, before we get off the idea of what the value of these businesses are, there's also a lot of structure in the offers or terms in the offers. I used to have an old partner that would say, you give me the price and I'll give you the terms. And so talk about terms and how that affects a offer.
There's a few levers that you can pull, and that's kind of like terms. So the first is obviously purchase price. The next is what percent of money is kind of, where are you putting down? Does the seller get at closing with kind of no strings attached? You can do deals at 0% down. You can do deals at all cash. And so all of these kind of talk about who is sharing the risk. And so that's a lot of the negotiation is generally on one side is the buyer, the other side is the seller, and one person bears more risk. Like they should get more potential return for that. And so if the buyer puts down more money, that they're taking on more risk. If the seller carries a larger kind of seller note and gets less cash down, they're taking on more risk. And you can structure loans, interest only, amortizing, what's the interest rate? So there's a lot of different levers in there. And then there's either earnouts or clawbacks. And so those are both saying, hey, we'll pay you additional money if these certain conditions are true. A clawback would be, we're going to pay you this amount of money if clients don't leave, but if clients fire us within whatever the period is, then you get paid less money. And an earnout would be the opposite of that. It's, if you hit your projections or there's X number of doors, it's very similar, but it's kind of money after closing for the performance of the business on the backside.
And talk about the earnout. Like a lot of people will come to us and say, hey, once I hand them off to you, if you lose them, it's your fault. How should people think about that?
It's a great question. I think that's like one, like reputation matters, like who you sell to, if you've got a deal that has these types of terms in it. I think number two is anytime there's change, there's risk of sellers. And that could be selling your business or any other kind of change. And then three, like there is just natural churn in this business. And so like from that perspective, like if you're going to lose 5 to 15, 20% of the business, but the seller or the buyer of that business gets kind of no credit for that, like that's not sharing like risk equally. But it's a totally fair point. Like if the seller exits, and most of the sellers that we buy from do exit, and they have no control, like, yeah, that's a scary thing. And you got to really trust that the buyer on the other side,
that they know what they're doing.
They know what they're doing. They've done this before.
For instance, you may not sell to somebody that's their first time to buy a property management company unless they give you all cash because of if they have a clawback associated with churn and they don't know what they're doing, it'd be like handing your Ferrari over to a 16-year-old. He or she's never driven that thing before. And if they wreck it, then you're SOL.
I like that. PM businesses are like Ferraris. I like that.
Well, they're more expensive in most cases than Ferraris. So for sure.
It's worth a couple Ferraris.
Well, I think this kind of gets in, this is a great kind of segue because it's really the first question in the 3 things in diligence. And it's going to continue on along this churn discussion. Why would a property management company buy a business that if it has 20% churn, I know this is not a perfect math, but arguably you'd lose all your doors in 5 years.
That's how the math works. When you run it on a spreadsheet equally,
But think, I guess my question is like, think about that. And so as a buyer, we're willing to do that, but why are we willing to do that? And
so, there's a couple reasons to do that. And like, yes, I think over a long enough period of time, like the doors do go away. Now you've got to have a sales and marketing function to kind of refill the bucket. I think the reasons that we do that is number one, what we've shown over our acquisitions is that we are able to grow the revenue even when you factor in churn. And so, at the end of year one, we've got more revenue, even if some units have churned off than we bought. And so you're kind of pulling forward some of that cash flow and that profit. And then the second part would be strategically, if it gets you into a new market, it's a lot easier to have a business that has 400 units and have a BDM out there versus kind of greenfielding, which would be like trying to start a market organically. So it kind of jumpstarts you. And the third thing would be jumpstarting density. And so if we can buy and get from 200 units up to 700, I can go out and hire a plumber. I can hire an HVAC. Like you have more pricing power with your vendors. And so there's some strategic reasons why you would do this. And then maybe the fourth would be you get to a point where you've got slack in the system and you can absorb these and not have to hire. So they're very, very accretive. And so they don't always make sense. And yes, eventually the doors that you buy over the next, hopefully 10 or 15 years, like maybe they're not on the platform anymore, but the way that we'll get to valuation in a second, but we look at like the 5-year cash flows of this and you make money on them. And so those are a lot of the reasons why we do them.
You're kind of buying an annuity over some period of time. I'm willing to put cash up front for the predictable cash flow that we're getting on the backside.
Yeah.
One of the things that's interesting in how these businesses get valued is when you think about the brand that you're buying. If you're a seller, you have a lot of invested in that brand.
Yeah.
But what we have found with property management companies is they have very little brand awareness across the market.
Yeah.
And it's not because you're, Joe's Property Management. It's not because Joe's Property Management is famous that he's getting a bunch of leads and he's able to maintain not going out of like that churn, stay ahead of that churn. Yeah. It's usually because of Joe's hustle that he's staying ahead of the churn. And so I'll tell a quick story. I opened what was Golden Key, turned into GK Houses, hired you on the famous 1701 Oxmoor over here in Homewood. And I lived in the city where the office was. And all my neighbors would drive by that all the time. And nobody ever noticed our office there. And it's like on a fairly main street corner in Homewood. And what I realized is my brand had no brand awareness in the market. And so I think that the point I'm trying to make is if I tried to sell my business at that point with no brand awareness, I'm really just selling a chunk of cash flow. And the big question becomes, when does that cash flow run out? And I think that's what people that are selling today need to understand is, and I know I can almost feel the pushback through the microphone. I know that people are going to say, no, my brand is famous in XYZ city. But our experience has been there's very few brands that are famous. Maybe you have a good spot on Google, which you could argue is going away pretty quickly. But for you to, unless you have a brand that's naturally bringing in leads, then it's hard to buy your business as a going concern versus the cash flow approach to it.
Yeah. You
could probably say that more eloquently than me.
I think that there are businesses that, and the reality is you're talking about referrals for new clients. I do not know any property managers that the majority of their leads come through their website. Different than like short-term rental, like booking direct. And I think you've got a market for your guests. I think that's different. And that's where brand can matter, which is why I think that industry is still fragmented. Residents go to Zillow is just the reality. Like they've got a monopoly on renters. And so you would be buying it for the referral capacity. But the reality is a lot of property managers have to spend money on paid ads and they have to hire BDMs and there's whole vendors just focused on this. And so I've seen very few companies that just on a referral basis generate leads. I think that would tell you that you've got a really good brand. I can think of a handful in markets that have that. And it's so fragmented. There's so many property managers. I don't think it drives as much value as we all would like it to. And I think that's part of the reality. But I would say the pushback would be to changing brands is you lose whatever kind of like familiarity that you have in the market and therefore referrals, which would be part of like the upside and the growth. So that would be like the pushback on it.
Yeah. The inverse of that is, I mean, we're sitting here, you and I are creating content that will live out there in the ether for a long period of time and would arguably drive leads. Like we have a property management show, we have a YouTube channel, we have all these things. And so if we just quit marketing today, there would be a long tail of leads that would continue to come in. Like that would be the inverse of for brand, like brand awareness.
Yeah, I think brand's worth as a seller. It may be less to somebody buying it, but it doesn't have to be nationally known to get enough leads to refill the bucket for a 300 unit PM company in Richmond, Virginia. So, but yeah, I think we talked about that because we found it has been better to kind of be operationally under one brand and one system. There's other acquirers that do different things, but that does come up in the conversation. What's going to happen to the brand and the legacy and all those things.
All right, so churn was the first thing in diligence. The second one is really, we talk a lot to owners about the number of units per owner. I mentioned it earlier when we were talking about investor markets. Investor markets, typically investors will buy multiple units. Yeah. When you have client concentration like that, that makes us nervous. That makes a buyer like us nervous.
They can just leave in big chunks.
We've experienced them leaving in big chunks.
We have experienced that. And so when you see a business that has 400 units and 398 owners, it's just less risky. You talk to each owner less frequently.
They're not paying attention as much.
Yeah.
Not in a bad way. They're just as long as they're getting their check every month, they're not. Yeah, and they don't feel like if you make one mistake with one house and you make it up to them, they don't. If they have 10 and you make multiple mistakes on multiple houses, they don't see all 3 of those mistakes. They just see one at a time.
Yeah. The mistake percentage per house is the same, but it just feels a lot more on the net to the one investor.
It feels better to them.
It does. Yeah. So, that's just a reality. So I would look at that. If you have a business today, what's your units per owner? How many owners? How many top 5? So take your top 5 clients and what percentage of the total portfolio do they own? If it's more than 15 and the top 2 are 10 of that 15 percentage points, there's probably gonna be some structure around those clients in the deal. It's not unsellable.
Yeah. But. Well, and even we'll tell a story of us that happened in Colorado. We bought a business and there was a big client. I think he was 100 doors. And as soon as the clawback burned off, the next day we got a termination notice. The seller was making sure that he hung around long enough that this person got their money.
Yes. So
I guess the point though is even with while we would look at that and put some structure around it and say, hey, if this owner leaves during some period of time, we're not going to pay for this. Yeah. But the problem is if it's just 1 year, we haven't gotten our money back in 1 year. It's going to take multiple years to get our money back. And if we don't get our money back, then it's kind of like a waste. So it's like a big risk for us.
Yeah, it is. You just have to be very careful. And because we talked about brand, and the reality is it was Joe's hustle. Those big owners choose the PM because of a relationship and the execution. And when that changes, it creates an opportunity for them to do something else.
Well, and when I first got into the business, I felt this a lot. I felt like people thought of me similar to their real estate agent, where they were just telling me what to do. Yeah. And when I was hustling and I only had 100 doors, that was fine, right? Because I was trying to make everybody happy. Yeah. If they needed me to run over there and check to make sure a house is locked, I would certainly do that. And it felt like that was what you were supposed to do at that point. But as you get bigger, you need to systematize the service. And if an owner, let's say somebody manages a couple hundred doors, and if one owner is 80 of those, well, that owner can call that property manager on the phone any time of day. He or she's going to pick up, do whatever they need them to do. And it just feels more like a real estate agent relationship. Whereas when that comes on Evernest platform, it feels more like we're going to execute at a very high level. We're going to get things done. I would actually argue that we may be a better property manager and make better decisions than that other person, but it just feels different. And a lot of those investors don't like that.
And even if you try to replicate it, just change and people don't like change. people view change as risk. And so you could be the best property manager that sells, and you still have to rebuild that relationship. So it's just different than 100 units with 100 different owners buying there. So yeah, just be very kind of thoughtful about, especially if you have that in your book of business, like it's not unsellable, but these are the things that a buyer like us will look at and kind of question and might discount what you can pay for it.
The third thing we look at when we're really diligencing these businesses is the contracts. Mm-hmm. We're actually dealing with an issue right now with some contracts, mm-hmm. right? The management contract.
Yeah.
Talk about how we look at it around assignability, around what can we charge. Is it a closed-ended contract? Is it kind of like an open-ended contract?
Yeah. Assignability it's preferable if it states that it is assignable without the consent of the owner. If you have to get the owner's consent, it's just more work to get a deal closed. And then really looking at the fees. And oftentimes, like, they may have done other acquisitions. Like, you need to get your eyes on every single management contract, because it seems like I won't be that big of a deal. But the reality is I've had to give a lot of credits because the seller's management system said one thing, it said 10%, but a really old contract said 8%. And we paid we paid for the delta there, and we had to give credits for that. And so just really kind of deeply understand what you're buying. Maintenance markup, are you able to charge that? And so just kind of fact check what's on the P&L with management fee. And then our head of compliance would also say, do they have lead-based paint? Do they have all the disclosures? Do they have all the documentation? Those are kind of the top three things. There's obviously a lot more that we look at in diligence, but those are three things that we look out early on to make sure, it's something we want to move forward with.
Let's talk about one. Now we're moving on from those three diligence questions, and this is kind of like a post-transaction question that we're getting a lot. What do you do with my employees? How should I think about my employees once you buy this business?
So, yeah, that probably is the number one question that sellers get. And it depends. I'll maybe kind of talk about it. Like really, really small businesses where the sellers do the majority of the work, we likely won't bring over any of their employees. But for a lot of the businesses that are 300 units, they likely have a team of between 5 and 10. We try to, a lot of times sellers don't let us talk to their employees before. So a lot of this happens after integration. But our goal is in that first 30 days to kind of meet with every team member, interview them, see if there are seats on our team that they want to fill, and try to close that loop as quickly as possible, because it's a really scary thing. Hey, the business I was working for just sold. Do I have a job? Do I not? So we try to close those loops as quickly as possible. The reality is their job likely will change because the role is different. Like we might have very specific kind of focused roles, and what they were doing may be more of a generalist. And so their role may change, but we try to do that as quickly as possible. The reality is not everybody stays. Not everybody wants to, and then we don't have seats for everybody, because we may have maintenance techs already on our team and we don't need to retain their maintenance techs, or we may have enough property managers. And so it's different every deal. We're trying to be really thoughtful with it. And we try to, we're going to treat them with respect. We're going to be open and honest with them and try to do it quickly.
And there may be like a little bit of a cultural misalignment too.
Totally.
The thing I've found is a lot of times when somebody works for a small company, they're working at a small company for a reason. They don't want to work at a big company. Mm-hmm. Maybe it's the way payroll's done. They can't talk to the owner all the time, that type of thing. The other thing, which is interesting that I found, is you go from being a generalist. So at a small company, they're doing a lot of things. Hey, I'm going to go post these rents, and then I'm going to go hang a lot box on the door. Those are the types of days you would have at a small company. Whereas at a big company, it's a little more departmental. Actually, it's a lot more departmental. And their focus becomes more on one thing over and over and over again. And going from a small company where you're doing a lot of things, a certain personality would like the variety, and they don't like the non-variety of a bigger company.
Yeah. And then there's just like culturally things are different. And so we found some great team members through acquisitions. We've also like struggled to integrate. So like team members just like struggled to kind of integrate because it's just so much change, or it's like things are just done really differently. So I'd say like be aware of that, because you can also see churn if team members don't come over or if they leave after the transition. And so that's like another area that churn can happen if they've got deep relationships. So it's definitely something to understand when you're having conversations with somebody, if you're looking to sell or if you're looking to buy a business, and just being really thoughtful of what that looks like in the back end, knowing that, it might be a hard transition.
Talk about one more thing around employees or team members that we've experienced a few times, which is you have these employees that you inherit that have great relationships with these owners.
Yeah.
And then for whatever reason, the employee decides they don't want to work for the company and steals all of the owners and goes and works for somebody else. Talk about how we think about that today.
That first started happening, well, maybe 8 or 9 years ago. So it's happened for a long time.
We beat our head against the wall, so to speak, for quite some time.
I think that there's protections that you can put in place. But there are certain states that don't allow non-competes or non-solicits. So, and
to be clear, we don't care about non-competes. Like we want, or we do care. Like we want people to be able to go and earn a living. Non-solicit is what we're really thinking of.
Correct. Yeah.
Hey, we bought these owners. We don't want to just buy them and then somebody to solicit them away that has an inside track to soliciting them away. And as an owner, I'm answering your question.
Go for it.
As an owner, you're going to want to make sure that if you built the business and you created the value, that you can transfer that value to somebody else. If you can't transfer the value to somebody else, then somebody shouldn't pay for it.
Yeah, totally. Yeah. So if there's that much risk in it.
Yeah. So do with it what you want. And some people may say, well, I'm basically, offended by a non-solicit. Well, that's fine, but it's going to be hard for you to transfer value to a new owner. And you may say, well, it's your job to I've made this team member happy for a long time, and it's your job to make that team member happy. Well, that's fine, but you may not have a lot of sellers that are willing to take that risk.
Yeah, totally.
On somebody that they've probably never met.
Yeah.
In most cases. All right. So last thing, as we kind of put a bow on this thing, I think it's actually longer than we thought we were going to be, but we get excited about acquisitions. How should the seller think about their role? And this is dependent on who they sell it to, but how should a seller think about their role post-transaction?
The way it looks like for us is in the first 30 days, there are going to be questions. You might have a couple calls, for an hour kind of here or there. You're trying to transfer information because especially if there are terms, you want to set whoever's buying this business up for success. And then on the backside of 30 days, if there are issues, you're probably going to get phone calls from your clients. And so you want to make sure that as the buyer, I want a really good relationship with whoever we bought from, because it's really important to me that if there's any issues that we're on the same team, we don't want owners to leave, and we're kind of being, we're brought in. But outside of that, the seller's responsibilities kind of quickly dwindle down. I think it's one of the benefits of selling to us is after about 30 days, there's not a lot of requirements for that outside of kind of relationship and making sure that you're connecting the dots between client and whoever the buyer is.
But there's other acquirers, if you want to stick around for a little while, there's other acquirers that want you to be there. They're willing to pay you a salary to stay there, stabilize the portfolio. There's different flavors of this out there. One question I'll ask you is, as we finish this thing up, what is the thing we do differently today? Because you've been around for at least 30 of these 33 transactions that we did not do in the first few deals.
They look very different. I would say our diligence and the links at which we kind of diligence what we're buying is way stronger today. Our integration is vastly different. That's probably the biggest single thing. Is back in the day, it was send somebody from the market to move up there, and they're by themselves, and they've got to call the owners and integrate everything. we did not set people up for success back in the day. And today we'll have entire teams that are dedicated around calling all the owners and making sure that there are audits. And so there's just more of a team and more of a focus on the integration. And then our kind of checklist that's been, revised over 30 deals of, all right, we screwed that up. Let's not screw it up next time. Like that list has gotten really long and pretty in depth. So we're much better at integrating, I think, knowing what resources are required and what things we need to do today than we were when we did the first deal I kind of saw 10 years ago.
I'll tell you the one thing I think about all the time is when we buy businesses today, we have a historical churn analysis on the 33 deals that we bought.
Yeah.
And we basically say, hey, here's the average. So we have the expectation that that doors are gonna churn off.
Yeah.
And so when we buy the business, we fully expect some of those doors to churn off at a certain rate. Now, we really feel like we're better property managers than we were 12 months ago and 24 months ago. So we actually think we're gonna beat those numbers, but we've modeled it out that if we stay with the historical average, we're still gonna make money.
Yep. When I moved to Denver, we did not. And so expectations were probably based on...
Why did you lose so many doors?
Zero churn, and I lost 1% of our doors. And so we missed budget every month, Matthew. That's probably... I think we've got realistic expectations for what revenue attachment looks like and maintenance attachment. But back in the day, it was kind of like, oh, well, it should... On day one, revenues should grow and churn will just kind of be... consistent and not elevated at all if there's an acquisition. So I think our underwriting has gotten better, which sets. I think we can be more aggressive because of that. Because like we've got high conviction that we know what it looks like after 30 deals.
All right, Gray, this has been great. If you're interested, if you have any other questions, you watch this and it brought up some questions that are maybe specific to your situation, Gray and I would love to have a conversation with you. So feel free to reach out. We'll keep it confidential. We have these conversations all the time with buyers and sellers. So there's going to be a place for you to do that down below the video or somewhere. pmpath.co is our website for that. And that's it for this episode of the Evernest Property Management Show. We'll be back here in 2 weeks with another episode. See you then.